Lucid Group Inc. is trading at $6.16 per share during the active trading session on Wednesday, June 3, 2026, dropping slightly by 0.16% intraday. This price tells a story of extreme compression, but the immediate detail that should catch your attention is not the nominal single-digit value itself, but the massive, widening canyon between institutional trading volume and retail sentiment. While the broader public assumes this luxury electric vehicle manufacturer is stuck in a terminal downtrend, the underlying order books show an unprecedented level of accumulation by heavyweight sovereign funds, establishing a silent floor that completely contradicts the headline anxiety. This disconnect sets up a textbook struggle between immediate operational bottlenecks and a massive, deep-pocketed capital cushion. The narrative tells you the company's bleeding cash, but the data points to a highly calculated long-term asset accumulation strategy by its majority backers, who are effectively treating the public market like an extended private equity round. The general belief among casual traders using any major online investing app is that this company represents a cautionary tale of a luxury automotive startup failing to achieve manufacturing scale. The common view says that high interest rates, cooling demand for high-end premium electric sedans, and fierce pricing wars started by competitors like Tesla stock have completely eroded the thesis for holding this asset in an individual brokerage. Retail investors looking at standard investing sites often lump this ticker into a basket of distressed alternative energy plays that face imminent insolvency. However, the reality of the situation reveals a much more nuanced picture. Unlike other struggling electric vehicle players that lack a lifeline, this operation possesses an institutional backstop that turns typical retail bankruptcy assumptions completely on their head, forcing serious market participants to view the equity not as an independent automaker, but as a sovereign-backed technology play. To understand the current volatility, we have to dissect the intensive trading activity of the last few weeks. Recent sessions have seen trading volumes consistently hovering near 20 million shares per day, driven by heavy institutional repositioning following the first quarter earnings report on May 5, 2026. The financial markets received a stark reality check when the company posted a wider than expected quarterly loss of 2.82 cents per share against an estimated loss of 2.3 cents per share, while revenue came in at $282.46 million, significantly missing the consensus analyst target of $358.51 million. This severe top-line miss triggered a wave of short selling, dragging the stock closer to its 52-week low of $5.55 and sparking a flurry of legal investigations from prominent investor rights firms like Bernstein Liebhardt and Braunstein Gewirtz and Grossman over alleged disclosure delays. Yet every time the stock approaches those multi-year lows, immense block trades hit the tape, absorbing the selling pressure. This tells us that while momentum algorithms are punishing the short-term operational misses, long-term capital allocators are aggressively defending the lower boundaries of the trading range. The primary catalyst for the recent selling pressure stems directly from an unexpected operational hiccup that completely derailed the launch of their highly anticipated luxury sport utility vehicle. During the first quarter of 2026, the company managed to produce 5,500 vehicles, but only delivered 3,093 units, revealing a jarring disparity that immediately alarmed analysts. Management had to halt deliveries of their brand new flagship SUV for 29 days to a critical quality defect involving the second-row seats provided by an external supplier. This required a full pause to reverse an unauthorized component modification and inspect completed inventory. In the public equity markets, a supply chain bottleneck at the precise moment you are trying to ramp up a crucial product line is an absolute cardinal sin. It immediately constricts revenue recognition, spikes inventory carrying costs, and gives critics ample ammunition to claim the company cannot scale effectively. Comment below how many shares of Lucid Group Inc. you currently hold in your portfolio right now, or if you are keeping your distance until the delivery metrics improve. The tension between expectation and reality is further aggravated by the macroeconomic environment pressing down on the entire automotive landscape. High financing rates have significantly altered consumer behavior in the luxury segment, making a monthly lease or finance payment on a vehicle priced above $70,000 a much tougher sell for affluent buyers. This luxury slowdown is forcing large brokerages and institutions managing self-investing accounts to reevaluate their growth projections. When checking automated asset allocation tools like Schwab Intelligent Portfolios or browsing premium research platforms, the sector risk profiles for pure-play electric car equities have been dialed up across the board. Yet while retail sentiment continues to turn negative, the underlying equity structure remains completely anchored by Saudi Arabia's public investment fund, which retains a dominant majority ownership stake. This sovereign wealth fund injected an additional $1.5 billion in funding through an affiliate, using a mix of convertible preferred stock and unsecured credit lines. This massive capital commitment ensures the company has a cash runway that extends far beyond its current operational difficulties, creating a bizarre market phenomenon where a company with billions in negative operating cash flow faces virtually zero near-term default risk.
If you observe the trading behavior on advanced systems like the Interactive Brokers Trading Platform or look at active order books across major domestic market makers, you will see that short interest has remained highly elevated. Traders utilizing Interactive Brokers platform tools are paying premium borrow fees to bet against the stock, banking on the idea that the company will continue to burn through cash as it addresses its seat supplier issues. Meanwhile, long-term passive index funds managed by giants like Vanguard, BlackRock, and State Street continue to hold steady positions due to the company's inclusion in major benchmarks like the Russell 1000 index. This creates a highly compressed coiled spring dynamic, where any positive operational update regarding the resolution of their supplier issues could trigger a significant short covering rally. Conversely, any further delay in scaling production will keep the stock pinned underneath its heavy moving averages, testing the patience of even the most loyal institutional backers. Let us step back and look at what this business actually is, away from the daily noise of the ticker tape. Founded in 2007 and headquartered in Newark, California, the company initially focused on developing advanced battery systems and electric powertrains, before shifting its focus to building its own luxury passenger vehicles. Their core business model centers on controlling the entire technological stack in-house, designing proprietary electric motors, advanced power electronics, and highly efficient battery packs that deliver industry-leading range and performance metrics. Their initial vehicle, a high-performance luxury sedan, gained widespread critical acclaim for its engineering excellence, achieving an official temperament-rated range exceeding 500 miles on a single charge for its premium editions. This engineering prowess allowed the company to forge strategic technology partnerships, most notably signing a multi-million-dollar agreement to supply advanced powertrain and battery components to British luxury sports car icon Aston Martin. The company operates a direct-to-consumer sales model, bypassing traditional dealership networks, in favor of proprietary retail studios and an integrated online investment portal called Lucid Financial Services to handle vehicle financing directly. Production takes place at an extensive purpose-built manufacturing facility located in Casa Grande, Arizona, which has undergone multiple phases of expansion to support the introduction of new vehicle platforms. Historically, the company chose to enter the public markets via a high-profile merger with a special purpose acquisition company in 2021, a transaction that originally valued the combined entity at over $11 billion and provided a massive influx of growth capital. In the initial phase of public trading, expectations were sky-high, driven by a broader market frenzy for alternative energy assets and widespread belief that the company's superior powertrain efficiency would allow it to rapidly capture a dominant share of the premium automotive market. However, the operational reality of global car manufacturing quickly caught up with the firm. The company repeatedly struggled with severe supply chain disruptions, logistics bottlenecks, and manufacturing line calibration issues that forced management to repeatedly cut its annual production guidance in 2022 and 2023. While the company eventually stabilized its sedan assembly lines, producing 8,428 vehicles in 2023 and slightly expanding that output in 2024, the slow production ramp meant that fixed manufacturing costs heavily outweighed incoming revenue, leading to consecutive multi-billion-dollar annual net losses, including a massive operating deficit of over $3 billion in the 2024 fiscal year. Looking closely at the product lineup, the business relies heavily on two primary vehicle families to drive its commercial strategy. The luxury sedan family features multiple tiers designed to hit different price points, starting with the base model priced around $70,000 and scaling up to an ultra-premium triple-motor performance variant priced at $250,000. While these sedans have achieved immense critical success, winning numerous automotive design accolades, the absolute ceiling on the global luxury sedan market is structurally limited. This reality is what makes the successful rollout of their second product family, the luxury sport utility vehicle, completely paramount to the long-term survival of the business. The premium SUV segment represents a vastly larger and more profitable market globally. The vehicle has already started accumulating prestigious industry awards, securing honors like the 2026 World Luxury Car of the Year and matching top marks from major automotive publications. The underlying demand for the vehicle is clearly present, but as the first quarter supplier delay proved, demand means absolutely nothing if your assembly lines are paralyzed by an external component failure. This brings us directly back to the forward-looking expectations versus the immediate operational reality that will govern this stock as we move deeper into the current year. There are two distinct realistic scenarios that investors must prepare for. The optimistic scenario hinges entirely on an immediate, flawless resolution of the seat supplier quality issue, allowing the Arizona plant to rapidly clear the backlog of SUVs and accelerate deliveries throughout the remaining quarters of 2026. If management can demonstrate a clean, uninhibited manufacturing acceleration, the immense gap between current depressed revenues and fixed overhead costs will begin to close rapidly. Under this scenario, the company's unmatched powertrain efficiency and recognized luxury branding could position it to capture a significant chunk of the premium electric SUV market, forcing short sellers to aggressively buy back shares and driving a substantial re-rating of the stock towards its historical trading levels. Investors managing active portfolios on advanced platforms like SoFi Invest or a dedicated Fidelity brokerage account would view this as a classic turnaround play, where the underlying technology is vindicated by industrial execution. On the other hand, the pessimistic scenario is where operational inefficiencies persist and the company continues to face admired and compounding technical setbacks across its manufacturing network. If the luxury automotive market experiences further macro-driven demand deterioration, even an uninhibited production line might face a lack of wealthy buyers willing to commit to premium price tags. In this environment, the company would remain completely dependent on consecutive capital injections from its majority sovereign shareholder. While the Saudi Public Investment Fund has shown unwavering commitment, any future equity raises could come at highly dilutive terms for minority public shareholders, effectively capping the upside potential of the common stock and keeping the share price under persistent pressure. For retail investors utilizing standard self-investing sites or monitoring their individual brokerage accounts, this presents an ongoing risk of capital stagnation, where the company survives but fails to generate meaningful equity returns. When you look at the entire landscape, the central insight is that this is a company caught in a violent transition phase between pure engineering research and mature, large-scale industrial execution. The market expectations, as reflected in the current compressed stock price and active short-selling campaigns, are focused entirely on immediate quarterly metrics, supply chain legal disputes, and near-term cash burn. The operational reality, however, is that the company possesses highly respected electric powertrain technology backed by an almost limitless capital reservoir that is fully committed to seeing the brand succeed globally as part of a broader economic diversification strategy. The contrast between these two forces is exactly what creates the intense daily volatility we see on major trading applications, from Robinhood to active institutional platforms. Ultimately, the question is not whether the company has the financial resources to survive the current market downtrend, but how efficiently it can transform its capital into a consistent, uninhibited stream of premium vehicle deliveries. For active market participants, maintaining an objective focus on actual monthly delivery counts, rather than getting swayed by daily sentiment shifts, will be the ultimate differentiator in judging whether this single-digit stock represents a permanent value trap or an unprecedented long-term asset accumulation opportunity. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.